Welcome to Finantax Clips, your go-to source for everything finance. Today we'll be lifting the veil on a fascinating aspect of wealth management, the elusive tax loopholes for the ultra-wealthy. We're going on a journey, one where we'll explore how the richest of the rich manage to keep their wealth growing, often using strategies that are as complex as they are fascinating. So, strap in and prepare for a deep dive into the world of hidden riches. In the world of finance, tax loopholes are not a new phenomenon. They are, quite simply, gaps or ambiguities in tax laws that allow individuals or corporations to reduce their tax liabilities. This isn't magic, it's just a matter of knowing how to navigate the system. Tax loopholes work on the principle of exploiting the difference between the letter of the law and its spirit. For instance, a company might shift profits to a subsidiary in a low-tax jurisdiction to minimize its tax bill. It's like a game of chess, with moves and counter-moves designed to outwit the taxman. You might ask, is this legal? Well, yes and no. While some tax loopholes are perfectly legal, others fall into a grey area, and some are outright illegal. But it's a complex landscape, with the line between what's acceptable and what's not often blurred. Now let us look at some real-life examples of these tax loopholes in action. Our first case study focuses on a billionaire real estate mogul. Picture this, a high-powered tycoon whose empire of steel and glass stretches from coast to coast. But beneath this facade of towering success lies a maze of intricate tax labyrinths. This billionaire real estate mogul has mastered the art of navigating these mazes, exploiting real estate tax loopholes to amass even greater wealth. The first loophole is depreciation. While properties typically appreciate in value over time, the tax code allows for depreciation, a deduction that reflects the wear and tear on a property. This billionaire, like many others, claims these deductions, reducing the amount of income they need to report, and thereby their taxes. Then there's the 1031 exchange, a provision named after its place in the tax code. This allows an investor to sell a property and reinvest the proceeds in a new property, deferring any capital gains taxes. By continually rolling over investments from one property to another, our billionaire mogul effectively delays paying taxes on the profits indefinitely. And let's not forget the carried interest loophole. This little gem allows real estate moguls to have their income taxed at the lower capital gains rate rather than the higher income tax rate. This can mean a difference of many millions in saved taxes. Of course, these are but a few of the tactics employed. There are countless other strategies, each one carefully crafted to keep the taxman at bay. The end result? A vastly inflated fortune grown not just through business acumen, but also through the cunning use of tax loopholes. These practices, while legal, raise questions about the fairness of our tax system. They highlight the vast divide between those who can afford to hire armies of tax lawyers and those who cannot. They expose the gulf between the tax laws as they are written and how they are exploited by those with the knowledge and resources to do so. This case study gives us an insight into how the real estate industry can be a haven for tax loopholes. Our next case study involves a tech giant known to all. This behemoth of the technological world, whose products have become an integral part of our daily lives, has also been adept at navigating the complex world of international tax laws. While we marvel at their latest gadgets and cutting-edge technology, behind the scenes, a different kind of innovation is taking place. This innovation, however, involves intricate financial strategies and international tax loopholes that save the company billions of dollars every year. The primary strategy employed by this tech giant is profit shifting. Profits made in high-tax countries are shifted to subsidiaries in low-tax countries. For instance, the company might sell a product for $100 in a high-tax jurisdiction, but declare only $10 of profit there. The remaining $90 of profit is shifted to a subsidiary in a low-tax jurisdiction. In this way, the company significantly reduces its tax liability. Another strategy employed is the use of so-called double Irish and Dutch sandwich arrangements. These involve setting up two Irish subsidiaries and a Dutch company. Profits are funneled from one Irish company through the Dutch company and finally to the second Irish company, which is headquartered in a tax haven. This complex arrangement allows the tech giant to further reduce its tax bill. These strategies, while entirely legal, have raised ethical questions. Critics argue that such practices deprive governments of much-needed revenue, while proponents contend that companies are merely taking advantage of the existing tax laws. However, it's worth noting that these tax strategies are not unique to this tech giant. Many multinational corporations employ similar strategies to minimize their tax liabilities. The scale and success of this tech giant simply shine a brighter light on these practices. This case reveals how multinational corporations can use international tax laws to their advantage. They navigate these complex regulations with the same innovation and precision that they apply to their technological creations. But the question remains, is it fair? And more importantly, is it sustainable in the long run? Our final case study involves a well-known philanthropist. Now, philanthropy often brings to mind images of selfless generosity, of the wealthy giving back to society. And while that's often true, it's also worth noting how philanthropy can be leveraged as a tax strategy. Our philanthropist in question, like many others, has a substantial fortune. But instead of simply storing all that wealth, they've taken a different route. They've established charitable foundations and trusts, making considerable donations that in turn reduce their taxable income. Now, this isn't to diminish the impact of their charitable deeds. Many of these foundations do incredible work addressing a myriad of social issues and providing support where it's most needed. But let's look at the numbers. For every dollar donated, there's a corresponding reduction in taxable income. And for someone in the highest tax bracket, this could mean significant savings. Think of it this way. If you're in the 40% tax bracket, every dollar you donate could save you 40 cents in taxes. Moreover, by setting up a foundation, the philanthropist retains a degree of control over their wealth. They can guide where the money goes, and in some cases, even draw a salary from the foundation. It becomes a way to keep the wealth within their sphere of influence while simultaneously reducing their tax liability. And it's not just about money. Donations of property, art or shares in a company can also yield substantial tax deductions. For instance, donating shares can allow the philanthropist to avoid capital gains tax that would be due if they sold the shares themselves. So while we applaud the philanthropic efforts of these individuals, it's crucial to understand the financial advantages that come with it. The act of giving can indeed be a noble one, but as we've seen, it can also serve as a strategic move in the game of wealth preservation. This case exemplifies how philanthropy, while noble, can also be a tax strategy. Having seen these cases, one might wonder, what are the impacts of such tax loopholes? Well, let's delve into that. The effects of these tax loopholes are indeed profound, and they ripple out in numerous directions. Let's start with the economy. When the ultra-wealthy exploit tax loopholes, it creates a distortion in economic behavior. These individuals may choose to invest in assets or businesses not because they are the most productive or innovative, but simply because they offer the best tax advantages. This misallocation of resources can stifle economic growth and innovation. Now, let's consider income inequality. Tax loopholes often benefit the wealthiest individuals, allowing them to amass even larger fortunes. This exacerbates income inequality, leading to a widening wealth gap. The top 1% can accumulate wealth at an astounding rate, while the middle and lower classes struggle to keep pace. And what about government revenue? Tax loopholes can lead to substantial losses in government income. When the ultra-wealthy don't pay their fair share, the tax burden shifts to the middle and lower classes. This can result in reduced funding for public services and infrastructure, affecting everyone from school children to retirees. Furthermore, the existence of these loopholes can erode public trust in the tax system. If people perceive the system as unfair, they may be less likely to comply with tax laws, leading to further revenue losses and potential social unrest. Finally, these loopholes can create an environment where the wealthy can exert undue influence over political and economic policy. This influence can perpetuate the existence of these loopholes, creating a cycle that is difficult to break. So, as we can see, these tax loopholes don't merely allow the ultra-wealthy to save on their tax bills. They can distort our economy, exacerbate income inequality, reduce government revenue, erode public trust, and undermine our democracy. Clearly, these tax loopholes have far-reaching implications. So, what can be done to close these tax loopholes? It's a question that's been echoing through the halls of finance and government for years, and the answer is no simple one. However, there are potential solutions that could help level the playing field. First and foremost, we need to consider policy changes. Often, tax laws are written with the best of intentions, but they can unintentionally create opportunities for those with the resources and knowledge to exploit them. To counter this, it's crucial to continually review and revise our tax laws. We must ensure they are fair, effective, and leave no room for manipulation. This means not only tightening existing rules, but also being proactive in anticipating new avenues for tax avoidance as our economies evolve and new sectors emerge. Beyond policy reform, international cooperation is also key. In a global economy, wealth knows no borders, and neither should our efforts to ensure fair taxation. This calls for countries to work together to share information, harmonize their tax laws, and crack down on tax havens. The recent agreement by the Group of 7 nations to implement a global minimum corporate tax rate is a promising step in this direction. However, policy and cooperation alone are not enough. Transparency plays a pivotal role too. The more light we can shed on the financial activities of the ultra-wealthy, the harder it will be for them to hide their wealth. This could involve measures like public registries of beneficial ownership, stricter reporting requirements for trusts and shell companies, and more rigorous enforcement of existing transparency rules. Lastly, it's also important to remember that closing tax loopholes isn't just about collecting more revenue. It's about fairness and trust. When the ultra-wealthy pay their fair share, it helps build a society where everyone has the opportunity to succeed. The road to closing these loopholes is long and fraught with challenges, but it is not impossible. Indeed, it's a journey we must embark on for the sake of our economies, our societies, and our shared sense of justice. After exploring these tax loopholes, what is the key takeaway, one might ask? Well, let's delve into it. We've seen the case studies of the billionaire real estate mogul, the tech giant, and the philanthropist, each using different strategies to minimize their tax bills. These range from real estate depreciation to creative intellectual property maneuvers and philanthropic foundations that serve dual purposes. We've also discussed the impact of these tax loopholes. They create an uneven playing field where the ultra-wealthy pay a smaller proportion of their income in taxes compared to the average citizen. This contributes to increasing wealth disparity and puts more strain on the middle and lower classes. Potential solutions to close these loopholes were also explored. They include simplifying the tax code and increasing transparency and audits for the ultra-wealthy. However, these are not silver bullet solutions. A comprehensive approach combining policy reform, rigorous enforcement, and international cooperation is required to effectively tackle this issue. The ultra-wealthy have the means and the motivation to find and exploit tax loopholes, but remember, these loopholes are a result of complex and sometimes outdated tax laws that can be changed. It's a matter of political will and public pressure. So the final takeaway is this. Understanding these tax loopholes, their impact and potential solutions is crucial, because remember, understanding is the first step towards change. That concludes our exploration of tax loopholes for the ultra-wealthy. We're grateful for your time and curiosity. We'd love to hear your thoughts, so don't hesitate to dive into the comments section and join the conversation. To keep up with our latest content and delve deeper into the world of finance, make sure you're subscribed to Finantax Clips. This is Finantax Clips signing off. Remember, knowledge is power. Until next time.